Welcome to Property Addicts Australia, your home for everything property investing. Get an insider's view of what really works when building a portfolio. Learn how to avoid the common mistakes, plus get all the tips and tricks from the property investing experts Sana and Mona Ali. Join us to learn from the experts and set yourself up for long-term success in property investing. Proudly powered by propertytwins.com.au.
Welcome to the Property Addicts Australia podcast. We are Sana and Mona Ali, the Property Twins. We are mortgage brokers and buyers agents helping clients all over Australia build investment property portfolios. In this episode of Property Addicts Australia podcast, we talk about how investors leave equity on the table, which stops them from expanding their property portfolios. We also go through several valuation types that banks conduct so you can maximize that opportunity available to you. We also go through a case study where an investor purchased 2 investment properties using $300,000 in equity and maximize opportunity through the power of valuation shopping and maximizing the equity available to them.
As property investors, it's important for you to be able to maximize equity that you can access in your property. So what people do versus what they should do, right? Often people just go to one bank, and that means they may be leaving a lot of equity on the table. Or secondly, they may limit how much equity they want to access. So for example, they have the ability to access $300,000 and they say, well, I only really need $150,000 because I'm only going to buy one investment property at this point in time. So they really limit their potential and what they can do.
Well, that's where the concept of valuation shopping comes in, right? Looking at various lenders and how they might value your investment property or your owner-occupied property, wherever you're tapping into equity from. So ordering several valuations to see which stacks up most in your favor to expand or tap into equity. And that's where also the consideration needs to be which would be a flexible lender to release that equity, because not all lenders would do that.
That's right. Some lenders would control the equity, others will release it to you. We are looking for maximum flexibility. So if a lender is not going to release the equity, then that might limit you moving forward and as to what you could do with your resources. And so why is it actually important? Why is it important to tap into all the equity that's available to you?
Several reasons, right? It could be you being able to buy a better quality asset. It could be you dividing your funds between 2 investment properties. It could also be so you avoid lender's mortgage insurance on your next purchase that you're looking to make. So a good valuation can make or break any of these 3 goals that you are aiming to achieve with your purchase.
And as you go to lenders, right, you use up borrowing capacity and we go to lenders in a specific order. So if you tap into equity with lender A, then you have to go to lender B and lender C, so on and so forth. So once you have progressed through the chain, you may have maxed out borrowing capacity with lender A. So you may not be able to come back and access that equity at a future point in time.
Well, we've had clients, right, where they could access, say, $300,000 and they've said, no, actually, I want to only access $150K and to buy this investment property. And then I'll consider later what I want to do. Well, 99% of the times clients come back and say, actually, I want to expand that portfolio. Yeah. Your goals would evolve over time and you need to be thinking long term. So in this case, if they left the $150K equity with the bank, the lender may not let them access that.
And also lending climate could change over time and it may tighten. And then I had a scenario where clients said, well, we don't wish to access all this equity. We only want this much. So these clients went and bought an investment property. And about 6 to 9 months after buying that first investment property, they came back and they said, actually, we do want to tap into the additional equity so that we can buy our next investment property. We are ready to buy the next one. So now they no longer have borrowing capacity with the original lender because as rates increased, their borrowing capacity tightened. So what we've had to do to solve this problem is refinance them out to a lender where borrowing capacity is a bit more relaxed so that now they've been able to tap into more equity which will go towards another investment property. And they were fortunate that this was actually possible because of lender policy that worked in their favor. However, had they already taken out the equity originally from their existing lender, we may not have had to refinance them to tap into the equity.
Well, they were fortunate they could service because of the lender policy. Imagine someone who just doesn't service to get that equity back. And again, that's a massive opportunity cost, right? 150K could buy you a 600K purchase, 10% annual growth, that's 60,000, and then compounding over the years, massive opportunity cost, and not being able to move forward with the portfolio.
Well, in this particular scenario, for them, it means they will be able to fund a $600,000 to $650,000 purchase. If they were unable to tap into additional equity, they would have missed out on this purchase as well.
Yeah, and with the way the property markets are going, it's worth a consideration. Again, it's about best practice. Sure, you might have ideas on how it should look, but reality is very different to what you think might work. So make sure you're focusing on best practice, focusing on your long-term goals. It's it's not about the bank, but it's about your goals. It's what's in your best interest to expand that portfolio. And today you might not have that goal, but in 6 to 12 months that might change. So just take 2 steps back and say, what will maximize that opportunity for me?
That's right. So even putting aside, the lender interest rate that you may be paying, it all goes back to your goals. Where is life heading? What do you want to do with your resources?
Yep. And now just talking about different valuation types, right? There's different types of valuations. As mentioned, right, you have to order the valuations upfront. Firstly, that's essential. You can't go to 5 different banks to order a valuation. Let's be realistic. Each one will have a credit hit, a credit inquiry on your file if you do that. But your mortgage broker or as mortgage brokers, we order those valuations upfront. And with most lenders, they are at no cost to you. So make sure you have that upfront visibility of the valuations.
That's right. So there's a number of type of valuations that lenders would look at. So we'll just quickly run through those because it's good to know as to what it actually means for you. So we have the AVMs, the automated valuation models, whereby you propose a valuation of your property. Either the system agrees or disagrees, and then it spits out the valuation. And it's obviously based on statistical data, what the lender has in their systems. So
and historical sales as well, and it's analyzing. So some lenders, it might be very favorable to you and without needing any further analysis. But then there's desktop valuations.
Yeah. So the desktop values, there is some human intervention in that, like a valuer actually looks at, the specifics of your property, recent sales, and then either they agree or disagree or propose another figure that to what you have proposed for that particular valuation.
It doesn't need an inspection of the property, which is great. And typical turnaround is a couple of hours, right? We have the valuation back. That's where most lenders are heading into automated and desktop valuation models. But then there's also what's called short form and full valuations.
That's right. So at times we may require full valuation. That may depend on lender policy. For that, like there might be a specific policy you have to rely on, and for that you need a full valuation. Or it could, this short form valuation or full valuation means like a valuer physically comes out to your property and looks at the property, the specifics of your property, and then prepares a actual valuation report.
Well, with these short form valuations, they'll be putting a bunch of properties that they've compared to your home or investment and saying whether it's inferior or superior to those properties to determine. And they'll also be doing an environmental analysis, a market analysis, and giving a rating as well. But full valuations are required for, say, construction loans,
or of the plan
properties that are not ready. So you might have purchased a brand new property and the bank would only value once the property is ready. So again, a risk to consider when we come to property investing, but that's a type of valuation that's done.
So in some instances, it's vital that a full valuation or short form valuation takes place. So these scenarios include things like often like self-managed super fund purchases, right? Where normally lenders do require full valuations, or your property might be in a high density complex where there's a lot of apartments. Then the valuer wants a full valuation in that case. So there are instances where we need full vals. And even at times, we may have an automated val or a desktop valuation, but the lender system triggers and says, well, actually, for this property, for XYZ reason, we do need a full valuation conducted.
And non-banks typically do full valuations, and they do charge for valuations, whilst bigger banks or mid-tier banks don't. But lower tier non-bank lenders charge borrowers with a fee for every valuation that's done, and they do full vals. They don't rely on desktop and automated valuations at this point in time. And then there's long form valuation. So these are for more complex properties like duplexes or development sites. These are very, very comprehensive valuations. And the fee can range anywhere $1,200 to $1,500 or more for these properties. So recently, we were doing a finance for a client where they owned duplexes, joint duplexes on a block of land. The bank, it's complex valuation, long form, the bank required that. So we checked with several lenders and each one came back with, well, it's $1,200 to $1,500. Didn't make financial sense for these clients to pay for that valuation, right? Because the loan was existing. They were just trying to reduce some pricing on it. One of the lenders where they were already with the bank, we were going to then internally refinance, and the bank waived that fee and said, well, upon submission of this application, we'll pay for it. So again, it's about navigating those relationships and saying, well, how can we benefit our clients to maximize this opportunity? And in this case, the lender was happy to fund that $1,200 to $1,500 in valuation fee for these clients. And it was a win-win, right, for them, the clients and the lender. So make sure you're looking at valuations upfront as a first step, because we will come to a case study in a moment, but it can make or break what you're really able to do in terms of opportunity cost.
Yeah, and it will impact how much equity you're able to access. And then you tie that into borrowing capacity. Where is the best borrowing capacity? So it's different layers of all this, right, of doing this. It's not just one thing that a decision is based on. Like in the industry makes decisions based on interest rates. It's not just the interest rate. There's so much more to it, you expanding your portfolio.
It's valuation, it's loan structuring, how you set that up, how you structure the loans, how do you maintain the tax deductibility and
lender policy.
Maximizing the lender policy to your benefit. There's so much to lending than just the interest rate. And that's what the market will have you believe, that it's just about the interest rate.
Yeah, that's right. And that's what banks are generally competing on. But
I saw a Facebook ad from one of the banks, and it said, talk to our experts for the best interest rate. And it got me really thinking, what about the goals? What about the portfolio? Is it just about the interest rate? And it's interesting how the market's really brainwashed and conditioned to just focus on that rather than the valuations, the loan structures, and setting it up correctly right from the start is what we are looking at. But moving onto the case study, right, we need to talk about a case study as well with this.
Yeah, let's just say use an example where Jane owns a property and we order 3 different valuations for her property. Firstly, her goal is to be able to tap into the equity, and she'd like to buy 2 investment properties using those funds that she can access. So say lender A, we get a valuation of $1 million. Lender B, we get a valuation of $975,000. And lender C, we get a valuation of $950,000. In that case, depending on, say, Jane's loan amount, whatever she owes, so let's assume that with lender A, she can access about $300,000 in equity, lender B, about $280,000, and lender C, about $220,000. So as you can see, the highest equity cash out is $300,000, lowest is $220,000. That's an $80,000 differential.
Yes, that's huge because say 300 grand can be used towards two 600K property purchases as opposed to 220K might only get Jane into one investment property. Ultimately, it comes down to Jane's goals, but from a best practice point of view, it would make sense for Jane to go for the highest equity cash out because she might not even buy two properties. She might say, well, I'll buy one property and use the rest of the funds for another asset class and invest in another asset class to expand the wealth or the portfolio and diversify. So what would give Jane the max opportunity? And that's 300 grand. Again, interest rate would be a much lower discussion in this if Jane's goal was to expand that portfolio and buy multiple properties.
That's right. Like the gains will come in the future, right? The capital gains. And I understand, like from a psychological point of view, you may be just looking at a few basis points here and there on interest. That's what you can see now. But what you can't see is the future gains that you could have if you had a larger portfolio. Say two 600 grand properties means you have a investment property portfolio of $1.2 million. That grows 10%. You make $120,000. I'm just talking about 10%, right? In booming markets, that 10% may be a very small figure. The property might be growing 20, 30%, like at a very, very fast rate. 20% gain is 240 grand, and then 30% gain is 360 grand. So if you compare that with the interest, maybe the interest would like actually be dwarfed by the capital gains that you would have. So again, make decisions based on your big picture and long-term goals and not just small little numbers.
Well, let's say Jane just buys one property to start with. The rest of the 150K she'll have left should sit in the offset account, presuming the loan is interest only and structured correctly for Jane's benefit with tax efficiency in mind. She'll only be paying interest for what she used. So she'll be paying interest only on 150K. So in your mind, you might be thinking, oh my God, I'll be paying on 300 grand from the day dot. But really, you'll only be paying interest on what you use, assuming you are offsetting the correct loan, and also then be able to maintain that tax effectiveness for the funds that you've already used up. Just to recap, maximizing equity to build your property portfolio with valuation shopping helps you set up for the long term to expand your portfolio. Make sure you don't leave equity on the table and you are tapping into that equity even if you don't use it today, so you're able to expand your portfolio as and when the opportunity arises. Thanks for listening. Join us next time for another episode of Property Addicts Australia podcast.